Following podcast was recorded on Tuesday, May 16th, 2023, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our presenter, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim answers the questions, why are the markets so calm ahead of the debt ceiling? Jim, there's some questions about the real X date. What is the Treasury Bill curve telling us?
Yeah, so if we go to the first chart, Janet Yellen put out a letter yet again on May 15th, the day before we recorded, saying that we're going to run out of money on or around June 1st, end of May, beginning of June. And there is some question as to whether or not the market is completely bought into that idea. So let's start with the yield curve, the Treasury Bill yield curve. So the blue line on the chart you're looking at is all of the Treasury bills. There's 54 of them that go out until end of April of 2024. And the orange line is the Fed Fund futures forward curve. What is the market projecting the future Fed policy? Now, in normal times, like you see on this chart between, say, July and September, usually these two lines trade on top of each other. And there really isn't much of a story, but that's not the case right now. The bill that matures on May 30th is yielding 3.48%. And the bill that matures 2 days later on June 1st is yielding 5.36%, 190 basis points of pickup over 2 days. The record was 2 days ago, I think it was 202 or something like that, but we've never seen anything like this in terms of this big a pickup in yield over such a 2-day period. Now, you can see that I've labeled all of the bills there, that the June 3rd, June 8th, and June 13th bills go all the way up to 554 in the yield, and then they start to drop off on June 15th, all the way down to 474 on July 6th. Now, what does all this mean? The biggest buyer of bills is usually a money market fund, and a money market fund is subject to daily reporting requirements, and they have to use fair value. If you own, say, that June 1st bill or that June 13th bill, and that date comes and there's no payment of your principal back, you have to mark that bill to fair value at the end of the day. What is that fair value? Is it zero? You didn't get paid your money, so it's worth nothing. Or is it 99.9 because you've just lost 1 day of accrued interest? You could have taken that money, reinvested it in something else, but you can't, so you lost that day's interest. And then it's 99.8 the next day and the like. Nobody knows. We've never done this. The SEC and the Fed and the other regulators are going to do what regulators do the best, which drives everybody crazy. They're going to offer no guidance. They're going to say to some Treasury money market funds, you go ahead and mark it, and we'll sit here and judge you. And if we don't like what you marked it at, we'll sue you, and we'll go to court for 2 years and argue it. If you mark it where we like it, you won't get sued. So out of an abundance of caution and why risk your franchise, a lot of Treasury bill or money market funds are selling these June bills. Now, I don't want to deal with having to mark these to market if there's a 1-day delay and get sued. I'll just buy some May bills, which is why that yield's depressed, and I'll buy some July bills, which is why that yield is depressed, and I'm defining that as well under the orange line. That's your neutral rate, and that's why the June bills are well above it, which are showing you that there's been some selling pressure raising yields on that. So I understand that argument. It's just not worth the headache to have to deal with it, even if you believe there's a low probability of it happening. You just want to avoid that issue altogether. But more to the point, it's really telling you that the only issue right now is in the first half of June. So if you go to the table, the next table, here's the bills that are at risk: the June 1st, June 6th, June 8th, 13th, and the 15th, the amount outstanding, less the Federal Reserve's holdings, this third column, and the private sector holdings. It's only 14% of the bill market. So what the T-bill yield curve is telling us is that June 15th seems to be a line of demarcation. I'm setting you up for your next question. And it's all in that June 1st to June 15th period, which is what we're all focused on right now.
Yeah, so what is the significance of June 15th, as you alluded to, Jim?
Yeah, so if you go to the next chart, here's the Treasury's cash balance. So think of this as the Treasury's checking account. And of course, their checking account is an account at the Fed, and they had, as of Friday, $139.9 billion in that account. Now, that account will keep running down because they don't have any more borrowing authority. The Treasury does to sell bills, get that proceeds, and put it into their TGA. That account also will continue to get withholding taxes. We all get paychecks and we all have withholding, and that withholding goes to the Treasury and it makes its way into that account as well. But generally speaking, as you can see, this is on a downward trajectory. So the Treasury has $139 billion to work with between now and June 15th. And I'll talk about why June 15th is important in a second. If we go to the next chart, there's also this list of extraordinary measures that the Treasury can use. And it just shows you that there's the Civil Service Retirement and Disability Fund, the Postal Service Retiree Health Benefits Fund. In other words, I've alluded to this in previous calls. That's the first line. And in the previous calls, what that is that there's many billions, $21 billion to be exact in those funds. And they can borrow, the Treasury can borrow and guarantee with the funds of these retirees' accounts. And as I've joked to in the past, if you run a private corporation and you tried to borrow to keep your corporation alive and guaranteed it with the funds of your employee's pension plan, you go to prison. But the Treasury in the federal government can do things that the rest of the world is not allowed to do. And then there's the Exchange Traded Stabilization Fund, and then there's the G Fund, which is debt issuance suspension period, and that it totals $333 billion, and they have $88 billion of these extraordinary measures left. So the 139 plus the 88 billion gives you something like $222 billion of spending that they can do to pay bills, to pay back principal and the like until June 15th. Now, why do I keep focusing on June 15th? Businesses have to pay quarterly taxes. June 15th is the next quarterly tax payment. So if we jump to the next chart, this chart here, this comes from Donald Schneider at Piper Sandler. He's their policy analyst, and he's kind of gone through line by line trying to figure out where the Treasury is going to be, and he's done as good a job as anybody. So the blue line is the previous two slides I've showed before, which is the cash, the TGA account, plus those extraordinary measures. And you can see that the blue line, is somewhere around that 222 billion now. And he anticipates that by June 1st, it gets down to around $20 billion, and it gets very close to zero around July 7th. And that orange line on the chart is just the 5-day average. And then on June 15th, it jumps up, to about 125 billion, and then goes to nearly 200 billion by the end of the month. That's quarterly tax payments by businesses. So if we can make it to June 15th, we get a bump up of quarterly tax payments, and then, as he shows, early August is when that number goes below zero. And so a lot of people on Wall Street are focused on this and saying, I know what Yellen is saying, and yeah, it's going to be really close. There's very little margin for error. But if they could make it to June 15th, the real X date is the end of July or early August. And a lot of people right now are focused on that early July or end of August period. And they're trying to say that that is the true X date that we should be focused on right now, not to where we are at the moment. Now, there's very little room for error. And this might be one of the reasons why Wall Street is calm about this, because what Wall Street seems to be trying to imply is we've got plenty of time to worry about this. There's really no issue that we're going to go for from here. The other thing that Wall Street might be also thinking about, and I'm in this camp too, that they're going to have to raise it. They're going to have to raise the debt ceiling. They cannot not do it. And we've seen this in the past. They come up to the line and then they do what's called a continuing resolution. That's fancy talk for they raise the debt ceiling just a little bit to give them another week or two, just so they could talk a little bit longer and negotiate a deal, but not raise it so that it's not a deal for a year and a half. So either they don't believe, they just think that when crunch time comes, somebody will give and there'll be a deal, or maybe that the X date is still 2.5 months away. And that's why, and the argument has been pushed, that's why you saw Biden and Speaker McCarthy push off their Friday meeting to the day we're recording, May 16th. They're acting like there's no urgency, because there isn't, because maybe they do know that they still have 2 more months and that they don't have 2 more weeks, that's just kind of political gamesmanship on June 1st. And in fairness to Yellen, even as Donald Schneider's numbers here show, we're coming really close to 0 by June 1st. And so any miscalculation, and we could still hit that debt ceiling as early as June 1st. And she might be saying, out of abundance of caution, maybe we ought to use June 1st as the debt ceiling date, even though we might be able to just skin by barely and make it to June 15th. There's still some uncertainty in there.
So Jim, what options does the president have?
He's basically got 4 options. Option 1 is payment prioritization. I will pay these bills, but I won't pay those bills. Now, there's 2 problems with payment prioritization. Problem number 1 with payment prioritization is the Treasury's already come together and said, look, they pay millions of people every day. Social Security benefits, welfare benefits, federal employees, there's millions of federal employees, vendors, they pay leases, they pay electric bills. They also pay debt ceiling, repayment of debt. They pay interest costs on the 15th and 30th every month. So they pay millions of bills almost every day. They don't have a computer system that they could call out and say, we will pay these bills, we won't pay those bills. The system is set up because no one thought to do it any other way, to pay the bills as they come in. So I'm not sure whether they could do payment prioritization. Could they prioritize debt payments over everything else? Because those are just a couple of dozen and they could be called out by hand. Sure, they could do that, but then there's a political issue there. You're going to pay rich bondholders, but you're not going to pay welfare recipients because you've decided that the rich bondholders are more important. I say that so you get the idea of the political problem that would pose if they were to do something like that. And then there's a legal problem. And the legal problem is Congress approves all spending. Congress does. The president just is the administrator of the spending. Congress's spending is all supposed to be treated equally. That, whether they approve spending for an aircraft carrier, for debt payment, or for Social Security benefits, they're all equal. They're all equal. You cannot say one has priority over the other. So that if there was a challenge in the Supreme Court, that could be a problem. Second option they have is the platinum coin, mint the coin, is what they refer to it as. In 1997 and then in 2000, they passed some bills to authorize the mint to print up collector coins, platinum collector coins, and they could stick a denomination on those coins. So they'll commemorate the 80th anniversary of D-Day, and they'll print up a platinum coin, and it'll have $10 as its value on our nominal value on it, and then you could buy it for $200. And I picked that example because that's exactly one that they did last year. And so these are not supposed to be coins of monetary value. These are supposed to be collector's items. And so some people got this idea, hey, why don't we print one coin that's $1 trillion? And why don't we send it to the Fed? And why doesn't the Fed say accept it as collateral and then print up or QE up $1 trillion for the government in order to continue to spend? Well, that will get challenged because I don't think it was, in fact, the congressman, I forgot his name right now, who wrote the bill in 1997 said this was not the intention of all of what the bill was supposed to be. The Fed has said even if you printed up the coin and you gave it to them, that they're not sure that they would accept that as legal, as something legal and binding, and then borrow $1 trillion against it. The Fed Reserve Act says they can only borrow against government guaranteed debt And this coin, it is unclear whether or not it would meet the qualifications of government guaranteed debt. So the point is that's kind of a non-starter as well. Another option is the 14th Amendment. The 14th Amendment was instituted right after the Civil War, and in the 4th article, it says that the debt of the United States shall not be questioned. And the reason that they put that in there was when they reintroduced the South back into the United States. Remember, it was a Confederacy, it was a separate country. All those senators and all those congressmen came back into the House and Senate. They were afraid that that's a lot of Southern senators. And they were afraid that those Southern senators would band together and say, we're going to set up a bill that the North, the United States, is going to pay the Confederacy's war bills or war debt, repay that debt instead of letting it default, even if it means defaulting on the North's debt. So they put into the 14th Amendment, you cannot question the North's debt. The debt of the U.S. Treasury shall not be questioned. So people have used that argument as well to say that the president can, suspend the debt ceiling and could start raising debt. Now that brings up two problems. One, Article 1, Section 8 of the Constitution says that Congress approves all spending. Congress approves all debt. It is unclear whether the 14th Amendment overrides Section 1, Article 8. It doesn't matter that that one came first or the other one came second. This is a matter for the Supreme Court to bring up, and there is a case to be made that that is a misread or an overreach of what the intent of the 14th Amendment was. Furthermore, if the president was to say, 14th Amendment, I hereby instruct Janet Yellen to start issuing debt, and they start issuing debt that afternoon, and then a couple of weeks later, it's fast-tracked to the Supreme Court, and the Supreme Court says, no, you misread the 14th Amendment wrong. That is an invalid way of looking at the 14th Amendment, strikes you down. What happens to all that debt you issued after you told Janet Yellen to ignore the debt ceiling? It's invalid. What does that mean? No one knows. So if you bought a bunch of Treasury bills and then the Supreme Court says it's valid, does the U.S. Treasury even have to give you back your money? You lost 100% of your money. There's no procedure for saying the Treasury issued invalid debt. You paid for that invalid debt. Now, what do they do with your money? They could keep it. They could give it back. They could do whatever it is they want. So you're at extreme risk if you buy those bills. Because again, like I said, there's no rules. There's nothing in the Constitution that says, what is the procedure for we issue debt when we're not supposed to? Then what do we do? Because that was never supposed to be a case. So these are some of the rules that the president has, but the way that I've structured it, none of these are clear cut. The only clear cut option is the fourth option, raise the debt ceiling, pass a law, and then be done with it. So we'll have to see how this goes. In the past, in 2011 and the like, we've gone to the brink and no one saw a way out. And then they invented the word sequestered, and then they did some continuing resolutions and they bought some more time. Wait till they get to crunch time and wait till we see how creative they are. That's kind of the thinking on Wall Street. But I will say this, if this is really truly the time that we go over the side and we default and we don't pay back the debt, this would be the first time that Washington's got it right, because Washington always tells us that this is it, this is really it, they're going to really default, and then they never do. So maybe this is the time. If it is, the markets are not prepared for it because the markets don't believe it. Or if this is the time that we are going to hit the debt ceiling or the X date in early June and not make it to June 15th, some of the markets are not really prepared for that either. Yes, they're avoiding those June bills, but that's out of a convenience thing. I just don't want to have the headache if it's one day or something like that. But they're really not set up for it. So as we walk into this, June 15th, we might be to June 15th, which pushes the X date out to the end of July. Oh, yay, we get to do this all summer then, instead of just 2 more weeks. And then there's also, they're just going to, at the 11th hour and 59th minute, come up with the deal, because that's the way all the deals in Washington work. But lastly, like I said, this is why the markets are so sanguine. This is why they really haven't priced this in. But if this is the time that they're really going to use a crypto term, rug us, and this is going to be the time that they're really going to default on the debt, not all the other times, I think it will come as a big shock to the markets because they're largely assuming that this is more theater than substance, and we'll see what happens in the next couple of weeks.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks and have a great day.